Welcome to the Journey of Bitcoin, Part 2. In Part 1, we went through topics that help you understand the journey of Bitcoin and the process from user to user. Let's strap in and get into Part 2 of this revolution happening before our very eyes. Beyond simple transactions, Bitcoin's underlying technology enables the development of advanced features like smart contracts and tokenization. In this section, we'll provide an introduction to smart contracts, their capabilities, and how they facilitate self-executing agreements on the Bitcoin blockchain. We'll also touch upon tokenization, the process of representing real-world assets on the blockchain, and its impact on various industries. Smart contracts are self-executing contracts with predefined terms and conditions written directly into code. These contracts automatically execute and enforce the agreed-upon terms without the need for intermediaries like lawyers or traditional legal systems. This automation eliminates the possibility of human error and ensures transparency, security, and efficiency in business transactions. The Bitcoin blockchain, which is primarily known for its use as a digital currency, is also capable of hosting smart contracts. The underlying scripting language in Bitcoin allows for the development and execution of these contracts, making it more than just a simple transactional network. So, how do smart contracts facilitate self-executing agreements on the Bitcoin blockchain? Well, let's take an example. Imagine you want to purchase a car from someone, but you're not entirely sure if the seller is trustworthy. With a smart contract, you can set up predefined conditions, such as verifying the car's condition, transferring funds, and registering ownership, all within the code. Once the conditions are met, the contract automatically executes, ensuring a smooth and secure transaction. On the other hand, tokenization is the process of representing real-world assets, such as real estate, artwork, or even intellectual property, on the blockchain. These assets are converted into digital tokens, which can be easily bought, sold, and traded on the blockchain. Tokenization has the potential to unlock liquidity, fractional ownership, and increased accessibility to traditionally illiquid assets. For instance, imagine you want to invest in a prestigious property but don't have the means to buy the entire property outright. Through tokenization, that property can be divided into digital tokens, allowing you to own a fraction of it. This opens up investment opportunities to a wider audience and democratizes access to valuable assets. Tokenization is not limited to real estate, it has the potential to transform various industries. From art and collectibles to supply chain management and intellectual property rights, tokenization can streamline processes, increase transparency, and reduce costs. This topic has outlined how smart contracts enable self-executing agreements on the Bitcoin blockchain and how tokenization represents real-world assets on the blockchain, revolutionizing multiple industries. Let's move on to topic 10, Bitcoin as a store of value and investment asset. Bitcoin's value proposition extends beyond transactions. In this segment, we'll discuss Bitcoin's emergence as a store of value and an investment asset class. We'll explore its qualities as digital gold, the role of institutional investors, and the potential benefits and risks associated with including Bitcoin in your investment portfolio. Gain insights into the evolving narrative around Bitcoin as a long-term asset. Bitcoin has often been referred to as digital gold due to its unique properties. Like gold, Bitcoin is scarce and has a limited supply, making it resistant to inflation. Additionally, Bitcoin is decentralized, secure, and divisible, making it a viable option for storing value in the digital age. The rise of Bitcoin as a store of value has attracted significant attention from institutional investors. These institutional players, including hedge funds, asset management firms, and even publicly traded companies, have started incorporating Bitcoin into their investment portfolios. Their involvement not only adds credibility to the asset class but also indicates a growing recognition of Bitcoin's long-term potential. So, what are the potential benefits of including Bitcoin in your investment portfolio? Well, for starters, Bitcoin has shown a historical track record of outperforming traditional investment assets, such as stocks and bonds, over the past decade. Its decentralized nature and finite supply make it immune to government policies and global economic fluctuations. Furthermore, Bitcoin offers diversification, as its price movements have shown a relatively low correlation with traditional asset classes. This means that adding Bitcoin to your portfolio can potentially reduce overall risk and increase potential returns. However, it's essential to consider the potential risks associated with investing in Bitcoin. The cryptocurrency market is highly volatile, and Bitcoin's price can experience significant fluctuations in relatively short periods. It's crucial to be prepared for market downturns and be willing to hold Bitcoin for the long term to potentially benefit from its value appreciation. Additionally, regulatory developments and security concerns should be carefully monitored, as they can impact the cryptocurrency market and investor sentiment. Now that we've explored the qualities, opportunities, and risks associated with Bitcoin's role as a long-term asset, let's touch upon the evolving narrative around Bitcoin. The narrative around Bitcoin has shifted from a purely speculative digital currency to a recognized store of value and a potential hedge against inflation. This shift in perception has contributed to its wider adoption and increased acceptance by traditional financial institutions. With the emergence of Bitcoin exchange-traded funds, ETFs, and growing regulatory clarity, more investors now have access to Bitcoin through regulated investment vehicles. This evolution further strengthens Bitcoin's position as a viable long-term asset class. And that's a wrap-up for Topic 10, on Bitcoin's value proposition as a store of value and an investment asset class. We've explored its qualities as digital gold, the role of institutional investors, and the potential benefits and risks associated with including Bitcoin in your investment portfolio. Coming up, Topic 11, Regulatory Landscape and Future Outlook. Regulations surrounding cryptocurrencies vary significantly from country to country. Some nations have embraced cryptocurrencies and implemented favorable regulations, while others have taken a more cautious or even restrictive approach. The lack of standardized regulations globally poses challenges for individuals and businesses operating in the crypto space. The regulatory environment surrounding Bitcoin continues to evolve. In this part, we'll delve into the global regulatory landscape for cryptocurrencies, including recent developments, challenges, and potential future trends. We'll explore the impact of regulations on Bitcoin's adoption, the need for regulatory clarity, and how regulatory frameworks are shaping the future of cryptocurrencies. Recent years have witnessed notable regulatory developments. Countries like El Salvador and Paraguay have adopted Bitcoin as legal tender, paving the way for mainstream adoption. On the other hand, several countries have introduced stricter regulations to combat money laundering, fraud, and illicit activities associated with cryptocurrencies. The challenges in regulating cryptocurrencies are manifold. Regulators must strike a balance between consumer protection, financial stability, and fostering innovation. Ensuring compliance with existing financial laws while accommodating the unique characteristics of cryptocurrencies is a delicate task. One significant challenge is the need for regulatory clarity. The lack of clear guidelines often leads to uncertainty and hesitancy among businesses and potential investors. Clarity in areas such as taxation, anti-money laundering, AML, and Know Your Customer, KYC, procedures is crucial for wider adoption and participation in the crypto market. Despite the challenges, regulatory frameworks are shaping the future of cryptocurrencies. Governments and regulatory bodies are realizing the importance of addressing the crypto market and are actively working on creating regulations to ensure investor protection, mitigate risks, and foster innovation. So, what can we expect in terms of future trends? Well, we might see increased collaboration between countries to create international standards and regulations for cryptocurrencies. This could help address cross-border challenges and promote a more consistent and transparent regulatory environment. Additionally, as cryptocurrencies become more integrated into traditional financial systems, we might witness the emergence of specialized regulatory bodies dedicated to overseeing the crypto industry. These bodies could provide expert guidance, monitor market activities, and ensure compliance with regulations. Overall, the future of cryptocurrency regulations holds both challenges and opportunities. Striking the right balance between regulation and innovation will be crucial for creating a thriving and sustainable crypto ecosystem. And that's a wrap-up for Topic 11 on the evolving regulatory environment surrounding Bitcoin. We've explored the global regulatory landscape, recent developments, challenges, and potential future trends. Remember to stay informed and adapt to the changing regulatory environment as you navigate the exciting world of cryptocurrencies. Topic 12 on common misconceptions and criticisms on Bitcoin is up next. Bitcoin is not immune to misconceptions and criticisms. In this section, we'll address some of the common misconceptions surrounding Bitcoin, such as its association with illicit activities and the notion of it being a bubble. We'll also explore the criticisms leveled against Bitcoin, including energy consumption concerns and scalability limitations, providing you with a balanced perspective on these important topics. One prevalent misconception is the association of Bitcoin with illicit activities. While it's true that cryptocurrencies have been used for illegal purposes in the past, it's essential to recognize that the vast majority of Bitcoin transactions are legitimate and lawful. Bitcoin, like any other financial system, can be misused, but it is not inherently illicit. Another misconception is that Bitcoin is a speculative bubble waiting to burst. It's true that Bitcoin's price has experienced significant volatility, leading some to believe it's a speculative asset. However, it's crucial to differentiate between short-term price fluctuations and the long-term value proposition of Bitcoin. Many experts argue that Bitcoin's limited supply and utility as a decentralized store of value make it a potential long-term investment. Now let's shift our focus to the criticisms leveled against Bitcoin. One prominent concern is its energy consumption. Critics argue that Bitcoin mining, the process by which new Bitcoins are created, consumes a significant amount of energy. While it's true that Bitcoin mining is energy intensive, it's important to note that the energy consumption is partly due to the security measures required to maintain the decentralized nature of the network. Additionally, the crypto industry is actively exploring and implementing more sustainable mining practices, such as renewable energy sources and improved mining hardware efficiency. Another criticism relates to Bitcoin's scalability limitations. Bitcoin's original design was focused on security and decentralization, which resulted in a lower transaction processing capacity compared to traditional payment systems. However, technological advancements like the Lightning Network and Layer 2 solutions are being developed to address scalability concerns and improve transaction throughput. It's crucial to remember that as a relatively new technology, Bitcoin and the broader cryptocurrency ecosystem are continuously evolving to address these challenges and criticisms. By addressing misconceptions and criticisms, we can gain a more balanced perspective on the potential of Bitcoin and the underlying technology. And that's a wrap-up for today's episode on addressing misconceptions and criticisms surrounding Bitcoin. We've explored common misconceptions, such as its association with illicit activities and the notion of it being a bubble. We've also addressed criticisms like energy consumption concerns and scalability limitations. Coming up in Topic 13, the future of Bitcoin and cryptocurrencies. The future of Bitcoin and cryptocurrencies is filled with possibilities. In this segment, we'll delve into the potential future developments in Bitcoin's technology, such as the integration of the Taproot upgrade, Layer 3 protocols, and advancements in privacy features. We'll also discuss the broader impact of cryptocurrencies on financial systems, the potential for mass adoption, and the societal implications. One exciting development on the horizon is the integration of the Taproot upgrade for Bitcoin. Taproot introduces improvements to the scripting language, enhancing privacy, efficiency, and flexibility in smart contracts. This upgrade has the potential to unlock new possibilities for decentralized applications and make complex transactions on the Bitcoin blockchain more user-friendly. Additionally, Layer 3 protocols are being researched and developed to further enhance scalability and interoperability in the cryptocurrency space. These protocols aim to build on top of existing blockchain networks, enabling faster and more efficient transactions while preserving the security and decentralization offered by the underlying blockchain. Advancements in privacy features are also anticipated. Privacy-focused cryptocurrencies and privacy-enhancing technologies are gaining traction, providing users with increased control over their financial information and transactions. This could potentially address concerns regarding the traceability of transactions and foster wider adoption of cryptocurrencies. Now, let's explore the broader impact of cryptocurrencies on financial systems. The decentralized nature of cryptocurrencies challenges traditional financial intermediaries and introduces new possibilities for peer-to-peer transactions, cross-border payments, and financial inclusion. As cryptocurrencies become more integrated into existing financial systems, we might witness the emergence of new hybrid models that combine the best of both worlds. Mass adoption of cryptocurrencies is another exciting prospect for the future. As user-friendly interfaces and infrastructure continue to improve, cryptocurrencies may become more accessible to a wider audience. With the increasing interest from institutional investors and the recognition of cryptocurrencies as a legitimate asset class, we might see a significant shift towards widespread adoption in the coming years. Lastly, let's consider the societal implications of cryptocurrencies. Blockchain technology and cryptocurrencies have the potential to empower individuals, particularly those without access to traditional financial services. They can enable greater financial freedom, economic empowerment, and contribute to more inclusive and transparent systems. However, it's crucial to address challenges related to regulation, consumer protection, and wealth inequality to ensure that these benefits are realized by all. The future of Bitcoin and cryptocurrencies is filled with endless possibilities. As technology continues to evolve, we must stay informed, adapt, and actively participate in shaping this transformative landscape. And that's a wrap-up for today's episode on the future of Bitcoin and cryptocurrencies. We've explored potential technological developments, the impact on financial systems, mass adoption, and the societal implications. Remember to embrace the possibilities and be part of the exciting journey into the future of this transformative technology. Up next, topic 14. Bitcoin's journey can be better understood through real-world case studies. In this section, we'll showcase several notable examples of Bitcoin transactions, highlighting their impact and significance. From large-scale commercial transactions to charitable donations and remittances, we'll explore how Bitcoin has revolutionized various industries and empowered individuals worldwide. These case studies will provide you with concrete examples of Bitcoin's practical applications and its potential to reshape the global economy. Our first case study revolves around a large-scale commercial transaction. Bitcoin has been used to facilitate high-value purchases, such as real estate and luxury goods. In 2017, a luxury property in Miami was purchased using Bitcoin, marking one of the earliest examples of a Bitcoin-enabled real estate transaction. This case showcases the potential of Bitcoin as a medium of exchange for significant commercial transactions. Another powerful example is the use of Bitcoin for charitable donations. Bitcoin's borderless and secure nature has enabled individuals to make donations to causes around the world, bypassing traditional financial intermediaries. For instance, the Pineapple Fund, started by an anonymous Bitcoin holder, donated over $55 million worth of Bitcoin to various charitable organizations, making a significant impact on philanthropic endeavors. Bitcoin has also transformed the remittance industry, allowing individuals to send money across borders quickly and at a lower cost compared to traditional methods. For example, in 2020, a Bitcoin transaction facilitated a cross-border remittance of $1 billion from a company in Argentina to a company in Paraguay. This showcases how Bitcoin can provide financial inclusion and empower individuals in regions with limited access to banking services. It's important to note that Bitcoin is not just limited to large-scale transactions, it can also be used for everyday purchases. Several businesses, ranging from online retailers to local shops, now accept Bitcoin as a form of payment. This acceptance of Bitcoin by merchants demonstrates its growing mainstream adoption and the increasing recognition of its practical use as a medium of exchange. These real-world case studies highlight the diverse applications and potential of Bitcoin. From commercial transactions to charitable donations and remittances, Bitcoin has revolutionized industries, empowered individuals, and reshaped the global economy. By embracing Bitcoin's transformative power, we can foster innovation, financial inclusion, and economic empowerment on a global scale. Bitcoin's journey through real-world case studies showcases notable examples of Bitcoin transactions and their impact on various industries. Remember, these case studies provide concrete examples of Bitcoin's practical applications and its potential to reshape the global economy. Coming up in topic 15, risks and mitigation strategies. As with any investment or financial system, Bitcoin carries certain risks. In this final segment, we'll examine the risks associated with Bitcoin transactions and how you can mitigate them. We'll discuss topics such as market volatility, security vulnerabilities, regulatory risks, and the importance of conducting thorough research and adopting best practices. Equip yourself with the knowledge to navigate the Bitcoin ecosystem confidently. Bitcoin is known for its price volatility, with significant price swings occurring within short periods. This volatility can result in substantial gains or losses for investors. It's crucial to be prepared for price fluctuations and understand that Bitcoin's value can be influenced by various factors, including market sentiment, macroeconomic conditions, and regulatory developments. Another risk to consider is security vulnerabilities. While the Bitcoin network itself is secure, individual users can be exposed to risks such as hacking, phishing attacks, or theft if proper security measures are not followed. Safeguarding your Bitcoin holdings requires implementing strong passwords, enabling two-factor authentication, using hardware wallets, and staying vigilant against potential scams. Regulatory risks are also an important consideration. The regulatory environment surrounding cryptocurrencies is still evolving, and changes in laws and regulations can impact the market. It's crucial to stay informed about the legal and regulatory frameworks in your jurisdiction and ensure compliance with any applicable requirements. To navigate the risks associated with Bitcoin transactions, conducting thorough research and adopting best practices is essential. Educate yourself about the technology, understand the fundamentals of blockchain, and stay updated with the latest news and trends in the crypto space. Additionally, following best practices, such as choosing reputable cryptocurrency exchanges, diversifying your investments, and being cautious with sharing personal information, can help mitigate risks. It's important to remember that while risks exist, so do opportunities. By understanding the risks and taking appropriate measures, you can position yourself to potentially benefit from the unique advantages of Bitcoin and the broader cryptocurrency ecosystem. As you embark on your journey in the Bitcoin ecosystem, always remember to stay informed, exercise caution, and seek professional advice when needed. That concludes topic 15. Up next we have a Q&A for you. Let's get some of these questions answered for you. Question: how long does a Bitcoin transaction take? Answer: Bitcoin transactions typically take around 10 minutes to be included in a block, but confirmation times can vary depending on network congestion and transaction fees. Question: are Bitcoin transactions anonymous? Answer: Bitcoin transactions are pseudonymous, meaning they are linked to public addresses rather than personal identities. While transactions can be tracked on the blockchain, achieving complete anonymity can be challenging. Question: are Bitcoin transactions reversible? Answer: Bitcoin transactions are designed to be irreversible. Once a transaction is confirmed and included in a block, it becomes part of the immutable blockchain ledger. Question: how can I secure my Bitcoin assets? Answer: securing your Bitcoin assets involves using a secure wallet, enabling two-factor authentication, and keeping your private keys offline. It's also important to stay vigilant against phishing attempts and scams. Thank you all for joining me over the last 2 videos on the journey of Bitcoin. I hope that you have gathered an insight into this digital revolution before us all. Ensure you check out my articles on www.lauriesuarez.blog daily, and subscribe to have the articles straight to your inbox. Thank you all very much for joining me. My name is Laurie Suarez.